Welcome back to another episode of the So What? Listen, today we're diving deep into the wild parallel between two of the most brutal shocks to ever hit the U.S. stock market, March 2020 and April 2025. Let's rewind the tape. It's March 16th, 2020. The world is frozen. The COVID-19 pandemic is in full swing. Entire countries are shutting down. Fear is spreading faster than the virus. Markets, absolute freefall. The SPY, the ETF that mirrors the mighty S&P 500, crashes nearly 12% in one day, its worst performance in history. It wasn't just a bad day. It was the day liquidity dried up. Circuit breakers hit. The VIX? It exploded past 82. That's panic in pure numerical form. The Fed steps in with historic rate cuts, trillions in quantitative easing. The global economy was on life support, but central banks became the emergency response team. Now, and you'd think we've learned to manage stocks better, right? But here comes April 2025. A different beast, but eerily familiar. This time it's not a virus, it's tariff shock. President Trump launches a surprise 10% blanket tariff across nearly imports. No heads up, no phased rollouts, just policy detonation. China and the EU retaliate fast and hard. And Wall Street? It reacts with the same panic we saw in 2020. SPY drops nearly 6% in one day, wiping out over $4 trillion in market value in just 48 hours. NASDAQ enters bear market territory. VIX spikes past 45. Analysts call it Liberation Day. But traders, they call it Annihilation Week. The fear, the same. The velocity, the same. The cause, entirely different. So, let's connect the dots. In 2020, the panic was about a global pandemic, health scares, and death. In 2025, it's about taxes, costs of living, and huge uncertainty. Same old game, but different rules. But both events have one thing in common. Shockwaves that rattled investor confidence to the core. The difference? COVID forced central banks to inject liquidity into the system. The 2025 tariffs may actually fuel inflation, forcing central banks to tighten monetary policy back, and that is a problem. So what now? For April 7th, Monday. Here's what we're watching. Support sits near SPY 485. Break that, and we could spiral into 480 to 475 fast. Resistance is stacked at 496 to 500, but rallies without volume? They're fakes, not breaks. CPI data hits midweek. A hot number, and this sell-off gets wings. Bull flags? Not yet. Bear flags? They're waving loud on the 4-hour charts. Over the next 90 days, brace for turbulence. Tariff wars are just warming up. Q2 earnings could get ugly. Input costs will surge. Recession odds. JPM says 60% by summer. Watch for RSI divergences on weekly charts. They'll flash green when the real bounce is near. Until then, every bounce is a sell, unless proven otherwise with volume and structure. So, what's the takeaway? Whether it's a virus or a trade war, fear always moves faster than fundamentals. But smart traders, they adapt faster. This isn't 2020. We won't get Fed lifelines this time. We'll get rate pushbacks, sticky inflation, and a whole lot of chop. The bottom line, stay tactical, stay hedged. Know your trigger levels and respect volatility. Trade with structure, not emotion. And most of all, don't just ride the wave, read the current. Thanks for tuning in. This is The Answer. You can find me in the Webull feedback chats, chopping it up and having a good time. Come find me, and please don't forget to subscribe. Oh, and hit that like button.